When you take a look at the bond market, it's pricing in a less hawkish Fed, but as Kathleen mentioned, inflation remains sticky. What messaging from Powell is appropriate at this point?
I would think that given the data that you just described and also the market expectations that have been priced in, I think the Fed would want to manage the market expectations well, saying that they would still likely continually watching the data very closely, but equally also signaling that they are not going to over-tighten, which is what the market is concerned about, having the recession risk. So I think the messaging will be key, apart from just delivering the expected rate hike this week.
So given what you have just said, are we expecting the messaging to be negative for stocks and bonds, positive for the dollar?
I would think that, I guess personally, I think the Fed would want to at least create a calm market environment. So I think going along with the things that seeing the inflation numbers moderating, they are recalibrating the magnitude of rate hikes. Therefore, I think the market should take it reasonably well. I don't think that the Fed wants to really surprise the market at this juncture because there are still a fair bit of uncertainty, and that could cause the market into a downward spiral.
Kheng Siang, when we look at what the Fed's been doing in terms of monetary policy, we've also had this big program of quantitative tightening as well underway. How is that affecting fixed income sovereign debt in the US, in your view?
Yeah, I guess the quantitative tightening would naturally be negative for the bond market as the Fed were to reduce buybacks and so on. Generally, given the cycle of the economy at this moment in time, that would lead to a rising bond yield environment. But we have seen a lot of that happen this year so far. I think going forward, the market should be looking at what should be coming in the next few months, next 6 to 12 months. And clearly the growth numbers that we are seeing are beginning to show signs of slowdown. So I think even with the quantitative tightening, some of the comments, I think the market is right now not going to be too much of a concern about that as they look forward that the Fed may pivot to a slightly different strategy.
Well, it certainly affects liquidity in some ways. So how do you at the moment look at sovereign debt right now? How are you really positioned with treasuries, and do you expect yields to rise again, as we saw only to levels which a month ago looked very enticing?
Yeah, I think in terms of the yield levels, recent rise in bond yields have made it very attractive. So therefore, from our point of view, we think that the rates market, especially the treasuries, would look attractive proposition for investors. Now, the liquidity for treasuries so far has been doing quite well. There hasn't been much of an issue. I guess we've seen that liquidity issue in UK a few months back. But generally on the sovereign bond side, we are seeing that the liquidity hasn't been an issue. I guess if you move to Asia on the local currency bonds, there are some markets whereby liquidity could be a bit more challenging, wider bid-ask spread. But basically, we're still able to get the trades done, and I don't think there would be any significant impact on investors' confidence in this respect.
How about high-yield bonds, Kheng Siang? I mean, given the uncertainty in the global growth environment, given the QT that we just talked about, high-yield bonds don't look that attractive. Is that a fair assumption?
Yeah, in general, higher interest rates level will create financing burden for a number of companies. I think for high-yield companies, especially right now, with spreads widening quite significantly over the year, there may be some funding challenges that they could be facing. So from that point of view, funding is one aspect. And the other is on the macro fundamental side, as we are expecting a bit of slowdown. So therefore, it could remain a fairly challenging credit environment. So I think for high yield, performance may still remain fairly challenged in the coming months.
Kheng Siang, just very quickly, just a few months ago, 2-3 months ago, everybody was a dollar bull. Now everybody's a dollar bear. Do you think when you get that herd mentality that with the FX being so hard to predict that people could be sideswiped?
Yeah, I think FX, as you know, is highly volatile. As you noted on the herd mentality, this year initially people were just mostly dollar bulls, and towards the end of the year, right now people are saying perhaps with the Fed potentially slowing down on rate hikes, dollar may be weakening. Now, we think that itself, while that's the general market expectations, there could still be some surprises if, let's say, there are certain macro fundamentals with certain countries out of line, and policymakers make certain policy decisions that are not so-called investor-friendly. I think we could get that surprises that could be whipsawing the currency markets at any point.